Welcome back to the Optify Deep Dive.
Glad to be back.
Jeremy Grantham, British investor, co-founder of GMO. He's really made a name for himself, spotting those market bubbles.
Yeah.
And really warning people about what could happen.
Right.
And he likes to look at history, right? He uses a lot of historical analysis.
Absolutely. He's a big believer in that.
And so we're going to check out this segment where he basically predicts what always happens before a financial bubble bursts.
Bubbles, enthusiasm, ecstasy, they're all kind of closely related. It's not an accident that the most euphoric periods in the market's history, all four of them really, 1929, 1972, tech bubble of 2000, the great financial crash, 2008, and you could add 2011, December. Those are the five euphoric points. And the first four, it's not an accident. They're all followed, not by the best economic times and the best market returns. They are followed by the four worst economic setbacks and the four worst periods of stock market return. What a strange coincidence. We all learned at business school that high PEs are meant to be reflecting the best possible future. And what we find is the highest four PEs, highest amount of euphoria, are precisely followed by the four worst economic outcomes. The Great Depression, the Great Recession of 73, 74, the worst since the Depression, the crash and the recession after the tech bubble burst, and the real moment of truth when the great financial crash occurred, when the whole financial system of the developed world teetered on the edge of total meltdown. What a strange paradox that the market's predictive power is precisely, perfectly the opposite of what we were taught. This is unique. Two fairly distinct events, one merging almost into the other. We had a classic bubble in every way, perfectly ordinary in context of the other four in 2021. And melting down the first half of 2022 was the worst market for stocks and bonds since 1939, the year after I was born. That's quite a long time. And then in November of that year, October or November, when they introduced chat, a handful of stocks that happened to be very large, that had a future that they could relate to AI, took flight. The rest of the market drifted lower, as a matter of fact, for another 10 months. And all of the gain, plus a little, was in the hands of the Magnificent Seven, all of which had an AI story to tell. And then finally, impressed by this steady advance, and also impressed by AI itself, the broader market jumped on board in late 23, the other day, really. And we had a broader market advance. So this is unique, as if you came in 1932 with some magnificent new invention, some really cheap fusion or something. And AI is serious. It will change everything. And therefore, it's not surprising the market took it seriously. The bigger the new idea, the bigger the new invention, the more the market becomes overpriced, the more it attracts euphoria. It's not accidental. Really great things happen in the internet phase, 98, 99, but they overdo it. They overdid it with the canals, apparently, in England. They overdid it magnificently all over Europe, particularly the UK, but also the US with railroads. They were spectacular bubbles. Now, the canals were huge. The railroads were even much more profound, changed everything. They were serious, but that didn't stop them attracting too much capital, charlatans, putting 8 different railroad lines between Manchester and Liverpool, or planning them and raising capital for them, when 1 or 2 was clearly enough. And the result was a bubble that broke for canals and railroads, and then somewhat the same with automobiles and radio and so on in 1929. Electrification of everything and development of mass markets for a lot of them. And then the internet. The internet was serious. We all use the internet. We can't live without our iPhones. And yet it was overdone. Everyone knows that Amazon went up multiple times in 99. It was the star of 99, which was a great year to be a star. And then in the break, it went down 92%. Very few people realize that. Amazon, huge success, went down 92%. And then it rose from the wreckage, as did a handful of them, and inherited the earth. How many, what fraction of those stars of 99 survived? I think 80% of the internet stocks just ceased to exist. Some were bought for scrap iron price. Basically, they ceased. And a handful of super leaders emerged. So the fact that it's a real idea doesn't say that there won't be a crash. It's quite the reverse. The more important the idea, the more guaranteed almost it is historically that it will attract too much short-term attention. Then there will be a crash, and then the railroads will change the world, internet will change the world, AI will change the world. But it would be classic for it to be overdone. That's what the history book is shouting at us. And to have that come in the middle, if you will, in the middle of a genteel, old-fashioned bubble forming and breaking, is to create a very novel and complicated twist. But it happens. That's what life is all about. Every now and then something really weird happens. And this is it. So where do we go from here, I think, is back to the history books. When you have these great developments, they overdo themselves in the short term. They crash in the intermediate term. And then they come out of the wreckage and change the world in the long term. And that's what I expect will happen this time. Look at the rules of thumb, basically, is what they are, that have been associated with previous recessions. And everyone knows them as well as I do. But the leading indicators are extremely good. The interest rate spread between the 6 months and 10-year and so on. And even the rising unemployment. They have very strong associations with recessions. I don't think anyone's really established the whys and wherefores, but we can see the association. I have no great insight as to whether the reason that they're associated is cast iron or not, but I can see the relationships. Whenever they're lined up like this, you have a recession. Now, I do have mild and obvious insight, if that's not a contradiction, into why it's dragged on so long. And that's the $3 trillion extra from the amazing COVID stimulus program. And what we found is the $3 trillion didn't disappear very quickly. It sat around in individuals' war chests, and it got to recycle. And yes, it's pretty darn small now, but it extended this cycle and extended it and extended it. So we were used to earlier times. We didn't have much. We had no historical experience with a stimulus of this magnitude. This was like a major war. This dwarfed the great financial crash, which was really a matter of teetering on the edge of near total financial destruction. And this time, we did more than ever. So this is completely novel, and we have to recognize that. So you expect different outcomes. And the ability to extend a cycle by a year or two, I don't think, looking backwards, should be seen as that amazing. We can see why it would extend with extra cash, and it did. It is a major surprise to me. The housing market, in a way, on a global basis, has been somewhat similar, except in China, which is important, by the way. In America, some regions were pretty good, some were not so strong. It's been an odd market. And if you think about the nature of a mortgage, you can get some idea. You've seen mortgages fall to almost ludicrous low levels of 3% and below. And you've sensibly, let's say, locked one in at 2.8, and now back, they want 6%. How enthusiastic are you going to be putting your house on the market the way you had intended a year earlier? And the answer to that one is pretty obvious, not enthusiastic at all. And so you freeze the market. And the best proof that that is a major component is the actual house turnover rate, which dropped like a stone and stayed dropped. And the turnover in the UK, Canada, Australia, it's a uniform feature of this era. So when you change the rate that profoundly, people feel, well, I've got this great asset. I've got this 30-year mortgage, or even in the UK, a much shorter-term mortgage. It's still financially significant. So people hold on to see what will happen. And everyone tells them the rates will come down in the not-too-distant future. And so they stop moving. They change their plans, or they rent their house, et cetera, et cetera. And you create cross-currents in that are not typical. And that's what we've seen. It's not so much a strong market as a weird market. Very local, very odd, sometimes dips, sometimes recovers, and generally speaking, fairly bamboozling from my point of view. Because in the end, if you lower the rate for 50 years, you lower the real interest rate structure, you're going to increase the value of almost all capital. Farms go from a 6% yield to 3%, forests do the same, the stock market does the same. Instead of yielding 5%, which it did for 80, 90 years, it yields much less. And you would think, therefore, when you move real rates back, that it would have an effect. I have no doubt it will, but I have lots of doubt as to how long it takes to flow through the system. How long does the real rate have to be considerably higher than zero, which it was, to push back on the price of assets? I don't know, but it's almost a mathematical certainty that eventually they relate. And any long-lived asset is not worth the same with a real rate of 2% than it is at zero. And yet that is not the immediate response for some of the reasons we're talking about. They're just strange. They lose volume and they act oddly. This is like a little interim, like the phony war at the beginning of World War II, where nothing seems to be happening in quite the predicted way. But in the end, basic relationships tend to exert themselves, and higher real rates mean lower asset prices, sooner or later. That would be a catalyst to watch out for the great monopolies. And they're not ludicrously expensive, as we know, by the standards of 2000 and the tech bubble. They sold at substantially higher PEs back then. But is the world more driven by monopoly today than 2000? Yes, it is. And if you don't act against that, you're likely to see huge earnings. And when you get to be that big, it is hard to sustain the 70 PEs of the tech bubble. When you're trillion-dollar market caps, it just becomes implausible to have such high PEs. And so we haven't. And so let's say one of the main reasons for that is the sheer colossal, unprecedented size of the current group of superhero monopolies. There's never been a period, never been a window like we've seen in the last, it's almost 15 years now, where the US outperformed in earnings by such a wide margin. The typical measure would be 15 or 20%, and then the following decade, the rest of the world would come back. This time, it's more like 80%, close, maybe 100% outperformance. And 75 or 80% of that are what used to be called the FANGs, and now the Magnificent Seven. They are the lion's share. When I say lion's share, they're close to 80% of the extraordinary outperformance the US corporate system over the rest of the world for the last, let's say, 12 or 13 years. It's just these couple of handfuls of stock. Slight change between the FANGs and the current iteration, but only 2 or 3 names. It does bring up an interesting topic, and that is, what are those periods when one took an enormous amount of grief for not understanding how important Japan was? When it was 65 times earnings, Solomon Brothers had a hit squad coming around explaining why mathematically, with rates so low in Japan, they were worth 100 times earnings. In the tech bubble, everyone was saying we had lost our way. We were fighting the bull market for all of 98 and 99. It was a huge move by the NASDAQ, must have nearly doubled. The S&P probably went up 50%. I wrote a paper called Waiting for the Last Dance, and everyone says, oh, you said that was a bubble. No, I said there is a bubble. They take a long time to form and break. But if you can't tell the difference between waiting for the last dance and let the wild rumpus begin, then you're not paying attention. So we were not saying that the bubble would break in the first paper. We were saying in January 15th, 2022, the wild rumpus had started, and it had. And then what we did not foresee is the introduction of AI as a complete game changer of long-term consequences, no doubt. And yes, I would avoid the US. This is a very much US-based event. And why would it not be? Because it's based on dramatic, unprecedented outperformance of US earnings. People don't say, oh, it's historically tended to cycle. Therefore, you should meet this with a lower PE. They say, oh, boy, are we kicking ass? And you have an unprecedented high premium PE. And that's the same, incidentally, with the growth sector, say, or even individual companies. If you have outrageously good earnings, they will be multiplied by an outrageously good PE. You have a whole market that does that, it will be multiplied by an outrageously high PE. That's classic double counting. And then when it goes down, like 1974, you have 6.8 times earnings. And what are the earnings? Totally crushed. So 6.8 times super world record low earnings. It is classic double counting. So you're selling at about a quarter of book value back in 1974. And conversely, at the top, 1929, peak profits times peak PE, 2000, peak new record profit margins times new record 35 times earnings on a trailing basis, blew through the previous high. And that's how we do it. We double count. The market does not make any attempt at predicting the future. The market is a coincident indicator of what makes money managers feel comfortable today. They love high profit margins, even though they mean revert. They hate inflation, even though it mean reverts. And that's the way it is. If you give me a market with high profit margins and low inflation in history, I will give you a high PE. And that's the way it's worked. This beautiful correlation between 0.8 and 0.9, the little model that Ben Inker and I put together at GMO over 20 years ago now. And we are now dealing with its second decent aberration since 1925. The first aberration was 2000. Our model said, wonderful profits, no inflation, you should have the highest PE in history, and we got that right. It just said it should be 23 up from 21, and it went to 35. So that bit we missed, the extra 40%. But this time, the diversion started in mid-21, when inflation suddenly popped up. And when it first popped up, it was a great surprise, though why it was, one historian might question, because we'd had such incredible stimulus, you might have been braced for inflation. But in any case, it came. And for the first time in history, the PE didn't crash. You had unexpected rise in inflation, and the market continued to rise uninterruptedly to new highs. Unprecedented faith that the Fed would make it temporary. And maybe with hindsight, today, you can say reasonably justified. But in any case, that was not the historical pattern. And that's a historical pattern of 90 years. That's not bad. And you broke it. And the market continued to rise. And now our model calls for perfectly reasonable PE on trailing or Schiller PE, trailing 10 years of earnings, of about 17 times. I think the long-term average is 15 or 16, and the actual is 32. So this is fairly spectacularly above the typical relationship on these major variables. So that's yet another way in which this current market is atypical. In terms of optimism, pessimism, at the bottom of the market in 2009, as it turned out, the day the market hit a low, I put out one of only 2 special one-page reports I've ever put out. Reinvesting when terrified. And it said, of course you're terrified, you should be terrified, but this is cheaper than it's been for 22 years, get your money back into the market. Not bad. Also, my first quote ever in 1982, the summer of 1982, market was getting down, to 7 or 8 times earnings. And the Wall Street letter, now defunct, had me towards the end. We were a brand new firm saying I thought we were near an unprecedented rally in both the stock and the bond market. And frankly, the turn in 1982 and the turn in 2009 are the only 2 market bottoms that really count. So I did get them. Secondly, or thirdly, I view this not as pessimism or even as contrarianism. I'm a natural contrarian. I believe 2 or 3% of general public can't stop themselves. So I'm attracted to market lows when everyone's pessimistic. I'm attracted to market highs. And let's face it, the 21st century has been one giant market high, basically, with that little dash in 2009, that little sprint to reasonable pricing. And that was it. The rest of the time, we've averaged 60% higher PE in the 21st century than the 20th century, and 30% larger share of profits of the total GDP pie. So it was a very different world we've lived in with very much higher prices. And I'm not sure how that will work out. But the bedrock is facts. Look at the facts, look at history, and make the most sensible relationship you can, knowing that the timing will be irritating and that your big successes, Japan, the tech bust, etc., will be the times when you take the greatest grief. The world is incredibly impatient and incredibly upset when it misses the great bubbles, misses even a piece of the great bubbles. We used to think it was very dangerous to underperform in a bear market. Nah, not at all. Underperform in a bear market, everyone's catatonic. They lose the ability to think until the market has bottomed out, and then they start to scratch their heads and think who they'll fire. But in a giant bubble, they're playing golf with their buddy who's 40% ahead of them, and Jesus, it drives them crazy. And they fire you on the run with great enthusiasm and talk to you as if, as I said before, as if it was deliberate. You're trying to hurt them personally. So the great bubbles are the most dangerous things to fight. And if you're sensible, and most investment firms and most advisors are, keep your head down and never fight a bubble. It's not good for business. It's much easier to run off the cliff with everybody else, as Keynes pointed out in 1936, because there is one, I think, pretty optimistic point of view in investing. And that is, in contrast to the American capitalist system, and maybe the global capitalist system, which I think has gotten fat and happy, and particularly in America, it's been allowed to become monopolistic. Monopolies, by the way, are great for stock markets. They're terrible for GDP and productivity. our productivity has dropped pretty steadily over the last 50 years in America. We're very pleased with ourselves now because we are less bad than Europe, which has plummeted. But we have drifted way down in productivity gains and GDP growth. Monopolies are not good. They're not aimed to have growth. They put profit margins ahead of growth. They're aimed for good earnings, which we have, good stock prices, which we have, and bad, if anything, declining growth rates, which we have.
Okay, and we are back. We're just going to jump right into this deep dive discussion. We've got this fascinating analysis from Jeremy Grantham, all about financial bubbles.
Oh, yeah. Jeremy Grantham, he's pretty well known for his predictions about market bubbles. Always interesting to see what he has to say, especially about what happens right before those crashes.
Right, like what really happens before those bubbles burst. So this deep dive, we're going to try to understand some of those patterns that he points out. Hopefully, help everyone be a little more informed.
Yeah, and maybe even spot those patterns ourselves, down the line.
Exactly. So Grantham, he starts off with this interesting paradox, right? He says the most euphoric times in the market, when everyone's super optimistic, those are actually followed by the worst economic outcomes.
Yeah, like the calm before the storm kind of thing.
Yeah, exactly. And he points to these high price to earnings ratios, these PE ratios, as a kind of hallmark of those euphoric periods.
Right. The PE ratio basically tells you how much investors are willing to pay for every dollar of a company's earnings. So a high PE ratio, it usually means that investors are really optimistic about future growth, but it can also be like a warning sign. Could mean the company's overvalued.
Overvalued. Okay, so then Grantham, he gives some examples to illustrate this paradox. He mentions 1929.
Oh, yeah, right before the Great Depression.
Exactly, 1929. And then 1972.
Another big recession.
Yep. And, of course, you can't forget the tech bubble.
2000.
2000, yep. And, we all remember 2008.
Oh, yeah, 2008, the financial crisis.
Yeah. So, all these periods of huge market exuberance followed by these really painful downturns. So it makes you wonder, why does this happen? Why does this pattern just keep repeating itself?
Well, Grantham, he thinks it all comes down to, investor psychology. During those euphoric periods, everyone gets caught up in this herd mentality, Everyone sees others making money and they don't want to miss out.
So they just kind of jump on the bandwagon.
Yeah, basically. And they start to think, this is it. The market can only go up from here. It's what economists call irrational exuberance.
Irrational exuberance, huh?
Yeah.
Interesting. So they're kind of disregarding the fundamentals of the companies they're investing in.
Yeah, they're not really looking at the underlying value. They're just focused on the potential for those quick profits and ignoring all the warning signs.
So they're basically driving the prices way up beyond what the company's actually worth, beyond its real earnings and growth potential.
Exactly. And then when reality finally hits, well, that's when you get those severe corrections.
Makes sense. Okay, so now let's talk about the current market. Grantham, he argues that, we might be in a similar situation right now, maybe experiencing another one of those classic bubbles.
And this time, it seems like all the excitement is around AI.
Yeah, artificial intelligence, all the advancements, all the potential. It's kind of like the hot topic.
Yeah.
So Grantham, he draws this parallel to some of those past bubbles that were driven by these groundbreaking innovations.
Right, like you think about canals, railroads, the internet, all these things that were totally revolutionary at the time. But they also led to these periods of overinvestment and speculation, followed by those painful crashes.
So are we saying, are we destined to repeat those mistakes? Is all this hype around AI leading us down the same path?
Well, Grantham seems to think it's a real possibility. He uses the dot-com bubble as a prime example. Remember Amazon? Their stock, I think it plummeted 92% after that crash.
Wow, 92%.
Yeah. But then, of course, they came back stronger than ever. Now they dominate e-commerce. So it kind of makes you wonder, could we see something similar with AI?
It's a pretty fascinating thought. These revolutionary technologies, they can have this huge transformative impact in the long run, but in the short term, it's like they create these market distortions.
Right, exactly.
And Grantham, he talks about some factors that might be prolonging this current cycle, making it even harder to figure out when things might change.
Yeah, it's almost like we're in uncharted territory.
Right. So he talks about all the stimulus that we've seen in recent years, especially that $3 trillion COVID relief package.
Oh, right. He thinks that might be artificially extending the market cycle. created this environment of easy money, and it might be delaying that potential correction.
So we're kind of this new situation, right, where like the traditional market models, they might not apply anymore.
Yeah, it's different this time, which makes it all the more interesting and, maybe a little bit dangerous.
Yeah. And then there's the housing market.
Oh, right.
Grantham points out some interesting trends there too. Like these historically low interest rates, they've created this weird dynamic.
Yeah, because all these homeowners who locked in those low mortgage rates, they don't want to sell.
Especially with interest rates now starting to go up.
Right. Who wants to trade a low rate for a higher one? So it's kind of frozen the market. Like turnover rates have plummeted.
So then the question becomes, what happens if interest rates keep climbing?
Yeah, that's the big question.
I mean, could it trigger a correction in housing prices? And how would that affect the broader market?
Yeah, it's all connected, right? Like a domino effect.
Okay, so we've got like this potential bubble, maybe driven by all the excitement over AI. We've got all this stimulus money potentially prolonging the cycle. And we've got this weird situation in the housing market. What else? What other factors are contributing to this whole, I don't know, precarious situation?
Well, Grantham, he also talks about the growing dominance of monopolies. Specifically, he focuses on these like the Magnificent Seven tech giants.
Oh, right. Like Apple, Microsoft, Amazon, Google.
Yeah, exactly. Those guys. The ones that, most of us probably interact with on a daily basis.
So how are they contributing to this potential bubble?
Well, Grantham says that, they've been a big reason why the U.S. has been doing so well in earnings. Like, they've driven a huge chunk of the gains, which has boosted the overall market, of course. But he kind of sees it as a double-edged sword.
What do you mean?
Well, their dominance is fueling all these short-term gains, but he thinks it could be a problem in the long run.
Oh, okay.
Because monopolies, they tend to focus more on profits than innovation.
So they're not really pushing the boundaries.
Yeah, and they can stifle competition, which ultimately, could actually hurt long-term productivity and GDP growth.
Interesting. So it's like their success now could be setting us up for a downturn later.
Yeah, that's what Grantham's worried about. Like, these companies may seem untouchable now, but their dominance, it could be creating these vulnerabilities in the market.
It's kind of scary to think about. And then Grantham gets into this really interesting area, the psychological aspect of investing. He talks about what he calls fighting the bubble.
Oh, right. How it can be so hard to resist those periods of euphoria.
Right. It's like when everyone around you is making money, it takes a lot of courage to step back and be like, wait a minute, is this really sustainable?
Yeah, he talks about how there's this huge psychological pressure to conform during those times. Like when everybody's making money, it can feel really isolating to be the one who's like, I don't know about this.
Yeah, it's like that fear of missing out. FOMO, right.
Exactly. Grantham, he actually shares some of his own experiences, like times when he identified market lows and it was so hard to stick to his guns because everyone else was convinced that the market would just keep going up.
Yeah, it's easy to get swept up in the hype. So how do you avoid that? How do you avoid making those emotionally driven decisions that you might regret later?
Well, Grantham says it's really important to stay grounded, to look at the facts, to study those historical patterns.
So it's not about being pessimistic. It's about being realistic.
Right. It's about understanding that markets, they go up, they go down. It's a cycle. And, you got to be prepared for those downturns.
That makes a lot of sense. So basically, he's advocating for this, I don't know, more level-headed approach. One that acknowledges that investing, it's not just about numbers. It's about psychology, too.
Yeah. For sure. He's reminding us that, we can learn from the past, but each bubble is unique in its own way. You got to be adaptable, pay attention to what's happening in the market.
Right. So I think we've covered a good amount of ground here in this first part of our deep dive into Jeremy Grantham's analysis.
Yeah, we've talked about all sorts of things, the psychological factors that drive those market bubbles, the potential impact of all these, groundbreaking technologies like AI, and, the role of all the stimulus money.
We've also talked about his concerns about the housing market and the whole issue of monopolies, how they're getting more and more dominant. It's a lot to think about.
Yeah, definitely. It's all part of this complex picture that he paints, of the current market environment.
So when we left off, we were talking about Grantham's idea of fighting the bubble and how tough that can be, especially during those times when, like, everyone's making money.
Yeah, it can feel like you're going against human nature, you know, to resist that easy money temptation. especially when you're seeing people around you like getting rich so fast.
Right. It's like everyone's winning except you.
Yeah, exactly. Yeah. And Grantham really captures that feeling, that pressure to conform, to just go with the flow. He tells these stories about investors who feel like they're the only ones not joining the party. And then they face criticism for being cautious.
He uses this great analogy,
Yeah.
Like running off a cliff with everyone else versus standing alone and questioning, like, where the heck is everybody going?
Yeah, it's a powerful image, right? It shows just how hard it is to be a contrarian investor, to go against what everyone else is thinking and feeling, even when you've got good reason to think that the market is, out of whack.
It can feel pretty lonely, I bet.
For sure. And Grantham doesn't just talk about the psychology of it all. He gets into the practical stuff too, like how fighting the bubble can actually hurt your business, especially if you're a pro investor managing other people's money.
Right, because if your clients see their friends getting rich in the market, they're going to expect you to get them those same returns.
Exactly. And if you're not delivering those huge gains, you risk losing clients. Your reputation takes a hit.
It makes you look bad, even if you're being responsible.
Right. Grantham's suggesting that even experienced investors can get caught up in that fear of underperforming, even when they know the market's overvalued.
Oh. So they end up making decisions that they know aren't the best just to keep up appearances.
Yeah, it's a tough spot to be in for sure.
So this whole system is kind of set up to reward risky behavior.
In a way, yeah.
Okay, so if fighting the bubble is such a losing battle, what are we supposed to do? Just sit on the sidelines and watch everyone else get rich?
Well, Grantham doesn't say we should do nothing. He says what's important is understanding those historical patterns, recognizing that when things get super optimistic, there are risks.
So it's about being prepared.
Yeah.
Not freaking out.
Right. He's saying we can't predict exactly when those corrections will happen, but we can educate ourselves. Look at the factors that have led to those corrections in the past.
Okay, so what are some of those factors? What should we be keeping an eye on?
Well, he mentions things like the spread between short-term and long-term interest rates and rising unemployment. Historically, those have been pretty reliable indicators, that a downturn is coming.
But he also says that things might be different this time around.
Right. He specifically points to all that stimulus we talked about before, the trillions of dollars pumped into the economy. He thinks that might be distorting things, making it harder to read those traditional signals.
So it's like we're in uncharted territory again.
Kind of, yeah. Like those old rules of thumb might not apply anymore.
Makes you think. So we've got these potential bubbles, maybe fueled by AI, all that stimulus money floating around, the housing market acting strange. And then there's the whole issue of monopolies. Where do they fit into all of this?
Right. Well, Grantham says that monopolies can make these boom and bust cycles even worse for a couple of reasons. First, because their profits, they're so huge, they can inflate how the market looks overall.
So it's like a false sense of security.
Yeah, they make the market seem healthier than it really is. And second, because monopolies can squash competition, they can actually slow down innovation, which hurts growth in the long run.
So while they might be driving profits now in the future, it could be a problem.
That's what he's saying. Yeah. And then when the bubble bursts, that correction could be even worse because so much of the market is tied up in just a few companies.
Makes you wonder if all those antitrust laws need another look.
Maybe so.
So what's the main takeaway here? What should people be doing differently based on what Grantham's saying?
Well, I think the most important thing is to remember that markets are cyclical. What goes up must come down.
So we shouldn't expect this bull market to last forever.
Exactly. Be prepared for things to change.
So how do we actually prepare for a correction?
One of the best things you can do is diversify your investments. Don't put all your eggs in one basket.
So invest in different types of assets.
Right. Stocks, bonds, real estate, you name it. And spread your investments across different industries and different parts of the world.
So don't just bet everything on the U.S. stock market.
Exactly. It's also a good idea to, maybe reduce how much you have in assets that seem overvalued.
So if you've got a lot of stocks that are trading at really high prices, maybe consider selling some of them.
Right. And then you can look for opportunities in areas of the market that haven't gone up as much.
Makes sense. What else? Well, it's also a good idea to have some cash on hand.
Cash is king, right?
It can help you preserve your capital during a downturn. And then when the market starts to recover, you can use that cash to buy things at a discount. So it's all about being prepared for whatever happens.
Right. And Grantham also emphasizes the importance of managing your expectations. Don't go into investing thinking you're going to get rich quick.
It's a long game.
Exactly. And there will be bumps along the way.
So you got to be patient.
Right. Don't panic when the market drops. Just remember your long-term goals and stick to your plan.
Easier said than done sometimes.
Oh, definitely.
Oh.
But it's good advice to keep in mind. And one more thing. It's important to remember that Grantham's analysis, it's just that. It's an analysis. It's based on his understanding of history and what's happening now.
He doesn't have a crystal ball.
Right. No one can predict the future with 100% certainty.
But his insights, they can definitely help us make more informed decisions.
Exactly. And be more prepared for whatever might happen.
So it's about understanding the risks, knowing a little bit about how markets have behaved in the past, and then making smart choices based on our own personal situations.
That's it. And maybe most importantly, don't be afraid to be a little skeptical, especially when everyone's getting excited and talking about how great things are.
Think for yourself.
Exactly. Don't just follow the crowd.
All right, so we've talked about a lot with Grantham's analysis. Bubbles, tech, stimulus, housing, monopolies, the psychology of it all. But he also points to some things that could actually trigger a correction, some specific catalysts.
Yeah, one of the big ones he talks about is interest rates. You know, they've been super low for a long time, but that era, he thinks it's coming to an end.
And that's going to affect, well, pretty much everything. Stocks, bonds, real estate, you name it.
Right, all those asset prices. They've been kind of artificially inflated by those low rates. So when rates go up, those prices are going to feel the pressure. And especially worried about housing.
Makes sense. Housing is so sensitive to interest rates.
Exactly. And a lot of people bought houses when rates were really low, so they locked in those low mortgage rates. Now, if rates keep going up, they're not going to want to sell. Who wants to trade a low rate for a high one?
Right, nobody. So what happens? People just stay put.
Pretty much. And that means fewer houses are being sold. Turnover drops, prices could start to fall. And Grantham thinks that could have a domino effect on the whole economy.
Yeah, people aren't buying houses. They're not spending as much money on furniture, appliances, all that stuff.
Exactly. Consumer spending drops, economic growth slows down, and then you've got the banks. They see housing prices falling. They get nervous about lending money. Suddenly, credit dries up.
A credit crunch. Not good.
Not good at all. So yeah, Grantham sees housing as this potential trigger, not just for a housing correction, but for something much bigger.
And it's not just interest rates he's worried about. He also talks about inflation.
Oh, right. He thinks inflation is already a bigger problem than a lot of people realize.
And it's probably going to get worse.
Yeah, he thinks so. Which means central banks are going to have to raise interest rates even more to try and get it under control.
Which could spook the markets even more.
Exactly. Lead to a sell-off. And then there's all this stuff happening around the world, you know, geopolitics.
It's a mess out there.
It is. Grantham's particularly worried about, well, obviously the war in Ukraine.
Yeah, that's having a huge impact on the global economy.
For sure. And then you've got the U.S. and China. You know, they're not exactly getting along.
Yeah, lots of tension there.
Yeah.
It's kind of a powder keg.
Grantham thinks so. He sees all of this, the economic stuff, the geopolitical stuff, as creating this really unstable situation.
So what are we supposed to do? I mean, it sounds pretty dire.
Well, Grantham's not saying we should panic.
That never helps.
Nope. He just says, you know, be aware of what's going on, pay attention, don't bury your head in the sand.
Stay informed, basically.
Right. And be ready to change your strategy if you need to. Don't be afraid to adjust your portfolio as things develop.
So it's all about being flexible. Right. Rolling with the punches.
Yeah. And remember, this is a long game. It's a marathon, not a sprint.
Don't get caught up in the day-to-day ups and downs.
Exactly. Focus on your long-term goals.
Mm-hmm.
And remember all that stuff we talked about before, you know, managing your emotions. Don't make rash decisions based on fear or greed.
Right. Easier said than done sometimes.
Oh, I know. But it's really important to try. Grantham actually thinks that investors who can keep a cool head, they might actually come out ahead. Like he sees opportunity in all this uncertainty.
Really? How so?
Well, if you're prepared, if you're thinking differently, there could be some great opportunities to buy assets at bargain prices.
So it's not just about avoiding losses. It's about potentially profiting from the downturn.
Exactly.
So after this deep dive into Grantham's analysis, what are your big takeaways? What stands out to you about all this bubble stuff?
Well, I think what really sticks with me is that even when you have all this amazing technology, all this potential, it doesn't mean the market's immune to a correction.
It's like a reminder that things can change really fast.
Yeah. And that history tends to repeat itself. Not exactly, but you see these patterns. So it's important to be aware of them, you know, to understand how investors behave, how they react to different events.
So it's not about being pessimistic. It's about being aware.
Right. And being prepared.
That makes sense. Grantham's analysis, it's definitely a lot to take in. But it's really insightful. It gives you a lot to think about.
Yeah, it's not just about the numbers. It's about psychology. It's about history. It's about global events. It's all connected.
And it's all constantly changing.
Exactly.
So for all of you listening out there, we hope this deep dive into Jeremy Grantham's analysis has been helpful. Maybe giving you some new things to think about.
We've covered a lot of ground, but we've only scratched the surface.
There's always more to learn. So keep exploring, keep asking questions, and stay informed. Thanks for joining us.
It was great to be here. Until next time.